Good morning, my name is Christopher Bell, Certified Public Accountant. In this video, we're going to cover the accounting equation. If you like the way that I teach, you can also book a one-on-one session with me. There will be a pinned comment in the comment section of this video. So what is the accounting equation? It's actually very simple. It is three components. You have assets, which are things that you own, and I have some examples down here that we'll cover in a second, equals liabilities, stuff that you owe down here, and then equity, which is the residual between assets and liabilities. Now, why do we have this equation? Well, number one, accounting is all about balance. Whatever you have on the left, also known as debits, must equal what you have on the right, also known as credits. So whenever you have a journal entry, an accounting transaction, in some way, either directly or indirectly, assets, liabilities, and or equity will in some way be affected. So how does this all work out? How does this shake out in the real world? Well, as an example, let's go ahead and do some math, which is always the best thing, right? So let's say that we have $100 in assets in a business, and this could just be cash, it could be inventory, it could be anything. Well, what could we possibly have? What various permutations of liabilities and equity could we have? It's a very simple algebraic equation. Let's say you have zero liabilities, the business has no debts. What must equity be? Well, since the accounting equation must always be equal, you would have $100 in equity. What if you had $50 in liabilities and then you had $100 in assets? Well, what do you think equity would be? It would have to be 50 to balance the equation. So sometimes you'll get problems or you'll be trying to solve something and you have to figure out, okay, what are the company's total assets? Well, you can move stuff around and use that to figure out whatever account balance you want or whatever balance you want. It's as simple as that. Now, to explore more why assets always equal liabilities plus equity, there's two ways. Well, really, there's three, but there's two obviously main ways that assets come into a business. A company can either buy assets by borrowing money. Let's say a company wants to buy some real estate down here. Let's say they want some real estate. How would they buy real estate? Well, they could do it with cash, which would just be a swap out of assets because you would have cash go down and then you would have real estate go up. Or they could finance that real estate. They could borrow money to buy that real estate. If that was the case, then we would have assets going up because we're getting a piece of real estate. And then we would have liabilities going up as well. Why? Because we owe money. We borrowed money. And there would be no impact on equity, assuming that we didn't issue any stock or do anything of that nature to buy that asset. Now let's think about how equity could be affected. Let's say that we need to issue stock. We need money. We need money to finance our business, but we don't want to borrow it. We want to have new shareholders come on board. Well, when a company issues stock, they receive cash and they give up partial ownership or equity in the business. So if a stock issuance happens, we have assets go up and we have equity go up. It's as simple as that. That's the accounting equation. At the end of the day, everything has to balance. And you'll notice if you actually look at a balance sheet, you will see that they have assets, liabilities, and equity. Have a wonderful day. Hope you learned something.